So these are the 10 questions. There are only 10 questions on preparation engagements. We will do all 10 of those so that after this, you're clear with preparation engagement. An engagement to prepare, the first one, and I want you all to answer, guys. An engagement to prepare financial statements in accordance with SSARS requires the accountant to be independent of the client? No. Independence is not required for preparation. Requires the accountant to make limited inquiries? No inquiries required. You will trust whatever management gives you. Requires the accountant to include a reference on each page restricting their use? No, they're not restricted use, they're free. Does not require the accountant to verify the accuracy or completeness of information provided by management or otherwise gather evidence to express a conclusion? No, you will not verify anything there at all. You will trust it to be correct. Are we all clear? These are not restricted use. Preparation engagements are not restricted use. You have just prepared the financial statements. They can use the way they want to. There's no restriction here. Think about it, right? When do we restrict something? Why do we restrict? I know restriction has a lot of confusions, right? We restrict something because it is not suitable for everyone. These are financial statements. You have prepared it. Now, you are not required to restrict it because you're not giving any opinions. An engagement to prepare financial statements in accordance with SSARS requires a written report to be issued? No, you are not required to issue a written report. No formal report required. Formal report required? No. Is a non-attest service and does not require a determination about whether the accountant is independent of the entity. That seems correct, right? That seems correct. We are not required to determine whether the accountant is independent of the service. Why? Because it's not an attest. That seems correct, but let's read the other options. Requires the accountant to obtain an understanding of the entity sufficient to identify his area of financial statement where there is greater likelihood of misstatement. We are not giving any assurance at all. So we don't need to figure out which areas are more risky. We don't need to. Does not require a written engagement? No, it does require a written engagement. An engagement letter is required. An engagement letter is required. It's required. Required written understanding of the client. It is required. The answer in this case is B. When after discussions with the client, an accountant prepares financial statements that contain a known departure from the applicable financial reporting framework for an engagement performed in accordance with SSARS, the accountant should. So you are preparing financial statements that contain a known departure from the applicable financial reporting framework. Disclose the material misstatements either in the notes or in the face and take no further action. Disclose the material misstatements either in the notes or on the face and issue a disclaimer. Only disclose the material misstatements in the notes. Only disclose the material misstatements in the notes. Only disclose the material misstatements in the face. What will you do? You are preparing financial statements that contain known departures. See, think about it. If you're preparing financial statements that contain known departures, right? You will disclose the misstatements either in the notes or in the face. You will not take any further action. You will not issue a disclaimer, because when is a disclaimer issued? A disclaimer is issued when you are not allowed to write that no assurance is provided. Here you're allowed to mark each page, right? Nothing is mentioned here. So you'll not issue a disclaimer. This is not a disclaimer of opinion. So if you are disclosing, you'll disclose the material misstatements either in the notes or on the face I don't think I have this point mentioned here somewhere. If after discussion, accountant prepares financial statement that contains known departure, the accountant should disclose the material misstatements in the financial statements, notes, or on the face of the financial statements, and take no further action. Stephen, no, you're confusing disclaimer with disclaimer of opinion. Disclaimer and disclaimer of opinion is different. Here we are not giving any opinion, so there's only disclaimer. Disclaimer and disclaimer of opinion is different. Normally, you're required mark every page of financial statements that no assurance is provided. If you're not allowed to do this, then you will have a disclaimer report, which will state that no assurance is provided. So either mark every page or write a disclaimer report. The name is same, but they couldn't be more different. So in this case, why will there be a no disclaimer? Why? Because this is issued, the disclaimer report is issued only when in the case the financial statements are not marked. I want you to highlight this. I want you to remember this. I know this could be confusing. I can see in the exams, this could seem logical. Why? Because you see, okay, hey, misstatements, but we are not giving an opinion. Issue a disclaimer. No, this disclaimer is issued only when you're not allowed to mark the financial statements. When a CPA assists in preparing the financial statements of a public entity but has not audited or reviewed them, the CPA should issue a disclaimer of opinion. In such situations, the CPA has no responsibility to apply any procedures beyond. See, you are there only to read the financial statements for obvious misstatements. In a preparation engagement, the only procedure which you have is read the financial statements for obvious misstatements. That's it. That's the only procedure you have. Read them for obvious misstatements. That's it. Nothing else. We will not do anything. We will not determine whether the management is elected to omit all disclosures. Will not determine whether they're in conformity with GAAP. Will not document the controls. We will just see them for obvious misstatements. The answer is D in this case. When a CPA is associated with the financial statements of a public entity but has not audited or reviewed such financial statements, the appropriate form of report to be issued is a disclaimer of an opinion. It's a disclaimer of an opinion. You're not doing anything here. You're just saying, okay, hey, I'm not giving any opinions. For public entities, you will have a disclaimer of opinion. An accountant is required to comply with the provisions of statements on standards of accounting and review services for the preparation of financial statements and providing these services. Drafting notes, maintaining depreciation schedules. Will we comply with SSARS in these cases? Will SSARS apply in these? Maintaining depreciation schedule is bookkeeping. Drafting the notes is assisting in financial statements. SSARS will not apply. SSARS will not apply in either of the case. Maintaining depreciation schedule is a bookkeeping service and drafting the notes is assisting in preparation. SSARS will not apply. When an accountant is engaged to prepare financial statements, each of the following applies, except each of the following applies. The accountant should verify the completeness of information provided by the management. No, we are not required to. So this does not apply. But let's read. The engagement document should include engagement letter and copy of the prepared financial statements. That's correct. The documentation in the engagement is the engagement letter. Yes. At the same time, the financial statements which you have prepared. These are the two documents. The agreed upon terms of the engagement should include identification of the applicable framework. Yes, it will include that. Identification of the applicable framework is a requirement. The engagement letter will include that. The accountant should include a statement on each page that no assurance is provided. Correct. B, C, and D applies. A does not apply, and therefore A is the correct answer. If a CPA concludes that unaudited financial information on which the CPA is disclaiming an opinion also lacks disclosure, the CPA should suggest appropriate revision. If the client does not accept the CPA suggestion, the CPA should issue an adverse opinion. No, we will not give any opinion at all. Accept the client's inaction because the statements are unaudited and the accountant has disclaimed an opinion. Describe the appropriate revision to the financial statements in accountant's disclaimer of opinion. Make reference to the appropriate revision and issue a modified report. See, there is no assurance. So A and D are clearly out. A and D are clearly out. You are auditing. If a CPA concludes the unaudited financial statements where you are preparing, on which CPA is disclaiming an opinion, also lacks adequate disclosure, the CPA should suggest appropriate revision. If the client should not accept it, what should the CPA do? If the client does not accept the revision, what should you do? If the client does not accept it, what should you do in that case? You know there is something wrong. If you didn't know something is wrong, then it's fine. Here you know that something is wrong, right? You know something is wrong. So you will not accept the client's inaction. You will describe the appropriate revision in the disclaimer of opinion. Then you will describe it, okay, hey, this is not how it should be. This is the correct way it should be. The next one. The CPA is considering whether to accept an engagement to prepare, which of the following statement is correct. The CPA should be independent. No. We are not even required to make a determination whether the CPA is independent of the client. Yes. In preparation, we are not required to make a determination at all. The CPA is required to disclose in the engagement any relationships. No, we are not even required to figure out whether we are independent or not. The CPA should obtain management's understanding regarding the benefits of accountant being independent. No. If preparation, you're not even required to determine whether or not you are independent. And the last question we have on preparation, there are only 10 questions we have. This is the last question. Which of the following situations preclude an accountant from preparing financial statements that omit all disclosures? Now, you are allowed to prepare financial statements which omit all disclosures, right? You're allowed to, except when it is done with the intention of misleading the users. Except when it was done with the intention of misleading the users. So the accountant is not independent. No, you're not required to be independent for preparation. The accountant becomes aware that omission was undertaken with the intention of misleading. So in that case, you will not be associated, you will not prevent. This is the correct one, but let's read. The entity's management has given the accountant permission to disclose the omission. No. Again, in this case, if they are allowed to disclose the omission, you can prepare it. No problem there. The entity's management has directed the accountant to omit the accountant's name from each page. No problem. You're not required to put your name anyway. Each page should have the mark that no assurance is provided. But if you know that it is done with the intention to mislead the users, then you will not prepare. That's the answer.